welcome back to another exciting episode of The Rational Investor. This is Julian reporting in, not from Thailand, coming in from Vietnam. As you can see, I'm not on the screen. You don't see my typical screen with the dashboard or TA, anything like that, trading view. We're actually showing a special guest screen right now. His name is Effie, or if you are part of TRI, his name is 1075 in the new Discord room. He's a veteran trader at TRI, has a lot of interesting, useful macro views, and he's prepared a really nice presentation for you guys while I'm kind of away from my traditional studio. So, I think without further ado, Effie, I'll let you take over, and you guys stick around for this extremely insightful and useful look at the macroeconomics of what is happening in the economy. And then in the after party, by the way, Effie is going to go into his technical perspective of where he thinks the market is going over the next couple of months. Okay, I'm going to let Effie take it over.
Thank you, Julian, for nice presentation. And hello, everyone. My name is Effie. However you spell it, that's okay. I go by the nickname 1075 on the website. And the way I like to do conduct analysis is to kind of like a serial killer police thing, like having a big whiteboard, and whatever I see, when I have some confusion, I throw it on the board and I try to come up confluences. As a profession, I'm an architect, so this is how I design. Actually, before I start a project, I put everything on the info, what the client wants, what's the land, what's the design language we will go for, and try to come up with the optimum scenario. So that's how I like to conduct these things, and thankfully Julian today invited me over, so I will share with you and what I see the confluences are. Doesn't mean that they are like 100%. Of course, the trading, investing, it's a probabilities game, and we try to always come up in the high probability side. And right now, this image that I picked up shows the teams of the market for me. We have different teams. We have the expansion team, which we can say usually on the expansion side of the things, the technology, cyclicals, and energy, they go stronger. And we have the inflation team, which we had mostly last year. Like energy was the outperforming sector of the market, and people were preparing for a recession, so they were pricing in consumer staples because they can reflect this inflation to their clients. They can the clients, the retail, they have no other option but to buy these things. They are not gonna stop buying food. So, okay, the cyclical sector, they kind of have a drawdown, but the consumer staples, they perform well in inflation environment. And we have the now new theme is the recession. It's been talked, but it wasn't really strongly priced in. But with the explosion of Silicon Valley Bank, what we see is the huge performance by gold, and some healthcare names started to catch a bit, and also some products that even in a recession you need to buy, like tobacco, alcohol, and the cheap products of the packaged food, they perform well. Now the market is debating whether we should add cryptocurrencies inside it as well. So, but when you check at the market performance for last few weeks, sector performances of the big names, we can see that the technology is now leading. It's a huge performance, and the financial side is lagging big time. But there are pockets of recession names staying strong, like there is healthcare staying strong, there is gold very strong, and consumer defensive names staying strong. So we can say the technology and communications performance services perform well, but it is like a little bit limited to the big companies. And this is also another theme, like these big companies, because when you have your portfolio diversified with many smaller market cap names, what you like to do in a recession area, you like to be able to move your funds to big names, and they get a good performance, which I think what's happening. Actually, the theme is recession, but it looks like expansion. So it's like a wolf in a sheep's clothing, somewhat. But you know, this is the market, how you make money. So if this is the case, we can make most out of it. But I try to position myself for this team, and I'll try to explain it to you why. When you go back to 2008, we have seen this happen. Before the Bear Stearns and the whole big capitulation, we see a 23% upside on Nasdaq. And also at 2000.com, before the big capitulation comes, we see a 42% upside. So in these market conditions, there are sometimes happen that the market goes up for a while, and then the capitulation comes, because market doesn't go straight down, as we know. But this is the bearish case, but let's finish the bullish case first. The bullish case is that, okay, we see on the Twitter, social media, you see it a lot. Fed is quantitative easing, printing money. Economy is getting so bad. Fed will have to ease, and this is good for stocks. And so the Fed will pivot, and there won't be any more rate hikes. They got cornered down, so let's go to the moon. And the bearish case is that economy is getting bad, inflation is still too high, Fed will not ease until something bigger breaks. This is the theme, like the Silicon Valley Bank or these other cryptocurrency banks. They are the start, but once the toothpaste is out of the tube, it's not easy to get it back in. So this will become larger and bigger by like a snowball effect. So this is the discussion, actually, more tightening of the monetary policy, because in the bearish case, the idea is that the market is not actually, even though you stop the rate hikes, because of the lending facilities of the banks, they get tighter. That kind of makes the money supply have a drawdown. So that already makes the market have some of a capitulation. And these lending facilities that the banks, the Federal Reserve provide to banks, are not equivalent of the quantitative easing. And also, you know, Fed was very adamant about they won't have a rate cut this year. But to continue with the bullish case, let's say, okay, this was the bottom and we are going up and up. We can make few arguments that the April is a great performing month in terms of last 120 years. We see a very high upside. And this Fred chart that shows that these liabilities and capital reserve balances with Federal Reserve banks going up high, and usually S&P follows it. And this is the quantitative easing argument. Also, you see in the many charts that shows the balance sheet of the Federal Reserve going up. That's another chart. This is more like correlated chart. And also the seasonality, you know. Last 20 years, the March was the bottom. And then we have a nice upside for the rest of the year. And we've passed through the March, and the market is, as you know, going up. So this is the bullish case. But for the market thinks, okay, the economy is so bad, Fed will ease, and we have our seasonality behind us, we have the balance sheet behind us, and so things will rally up, and they do. And the bearish case is that this is a bull trap. This is last hurrah before the big capitulation, because usually this is how it happened. And I go back and check the other crisis years, and I will show it now. And let's continue the bearish case, start the bearish case. And the first thing is that you see some headlines, right? Mortgage demand rises again. I think yesterday we see the new home sales were right on the rise again. UK inflation is high. President Lagarde, she says, okay, we need to do more. We can't do control the inflation. So it's clear the inflation genie is out of the bottle, and it won't be easy to solve this problem. If they cannot just solve this problem like the previous crises, like the pandemic times, they just print money out of the crisis. So with all this confusion, we had the Federal Reserve meeting, and this is somewhat of a summary what's been talked. And the Federal Reserve, they believe the soft landing is less likely, and they have another price hike they want to do. And they want to, after that, they want to hold till the end of the year. And this is the important part. Still expecting unemployment to tick up 1%. And as far as I know, once the unemployment starts to go up, it follows up. Like, it doesn't stop at 1%. It then becomes 2-3%. And this is the start of the economical contraction. This is how you could kill the demand. And they also repeated that the inflation was above their expectations. But why they are now not talking about raising till June? Because what they see, the credit tightening in effect, will be same effect with the rate hikes. And they changed their statement rather than ongoing increases in the target range. They said some additional policy firming may be appropriate. So Federal Reserve thinks that, and also this is their dot plot, which is similar. The lending facility effect will contract the economy. So what is this lending facility effect, right? And we usually in the crisis times that we have two similar times, 2008 and 2020. What happens is that the banks, they go and they take money from because they have this discount window borrowing area. They use that facility, and while using that facility, they also tighten their consumer loan standards, because this is something they pay interest on, and this leads into a crisis actually. And this is another way to show it, but it's the same chart. This is from Bank of America Global Research. We can see the uptick in the Fed discount window, and this is what you see on the social media, that how much Federal Reserve is printing money now, and that we will go to moon, everything will be good. But in reality, even if the banks, it's not like we print new money like COVID. It is the banks that just deposit their long-term treasuries, and in exchange they get liquidity that they can give if the demand comes. And last week, I think I read like $1.2 trillion they were being withdrawn from the banking system. So they are not printing new money. They just be able to give your money before going bankrupt. In literal terms, this is already integrated in the money supply. And so this is what the Federal Reserve thinks that will create the credit crunch, and will be like rate hikes will make the money less in the system, and that will prevent that will kill the inflation by creating a recession. And so okay, this is one tell for the bearish case, right? This is because all these periods when this spiked up, we had a recession. And the another tell is the yield curve inversion. And we know the yield curve has been inverted for a while, for last year. And now it is getting steepening back, or like getting uninverted, right? And yield curve inversion is a 9 out of 10 indicator, maybe better. This shows the recession actually, but it happens when it uninverts, not when it inverts first. And this is also from Bank of America, and you see the gray areas are the recessions. And once we have the inversion, we have the crisis when it starts to steepening back, and we have that on the COVID, we have it 2008, we have it at 2090s. It's the same. This is a very big risk on my investment strategy. Doesn't mean that it's gonna happen, but personally, the downside is big, which I will tell how I've tried to manage on my strategy. But this is another tell. So we have two cases for the bears. And then we have this, right? This performance of the Nasdaq that I shown previously about the charts, that also these small touches of, this is small touch at 2008, and this is the small touch at 2020s. And now we are at there, and you see the headlines. Even my friends now, they ask me, Efe, what's going on? Because the Nasdaq did the highest intraday uptick last week. We have the headlines, which is always a bad tell. But all of whenever it treats like this very strong uptick move, it's usually a tell that something is wrong. There is things that because of the sector analysis models. Let me show it to you. Yeah, this is famous sector rotation modeling, which shows that if we are in the full recession, market is already bottomed, and we should see technology, discretionary, and communication services to perform good. And there is some rumor, like ideas about maybe the algorithms, they mistake this and they keep bidding up, and that becomes the headlines. It becomes like a self-fulfilling prophecy, so forth to say. But it doesn't mean that it's gonna happen, but it is a nice tell. And let's continue the bear case a little bit more. So okay, then I come across this good research. That's okay. We let's see it on the chart, right? What happens? And this is 2008, Lehman Brothers, and the red is S&P, and you see this uptick, right? Before we start the capitulation, before the whole event starts, we have a little rally window, then we have a crash. So also we can look at the COVID crisis, that we have a uptick. In the green is the S&P, takes like 20-30 days, and by the 40 days we have the capitulation. And this is a invasion of Kuwait. It came much more faster, the capitulation, but we first had the uptick of market rallying up, then we had the capitulation, which this, these ranges 50-day, 40-day, 30-day, changes depending on the market conditions, but I try to get an average of it, and I'll talk about it, especially on the technical analysis area. And this is maybe an easier chart, right? More simplistic terms, these bull traps, and then the big capitulations. This may take a few months to play out. As we see, it's not going to happen tomorrow, But there is also a case to be made at the 9/11 when we had the first contraction. Then the market really bottomed and it rallied up. So whatever the efforts the Federal Reserve put out, it worked. So maybe this time it does as well. I don't know, but it's more likely for me the bearish case, and this is a better summary of 2008, which you can see it takes, before the whole capitulation. It starts from the start of the year. It's 1, 2, 6, nearly 6 months before we see the whole capitulation. And we've been having this news about the Credit Suisse and other things, other banks for a while. So the person who did this chart, they think that we are around here, and but we are like stronger than this, and we are going up. But it is few months away. The capitulation, you might say. This is the money supply. It's not really important, but one last note I like to show for the bear case is the GDP projection of the Federal Reserve. So Federal Reserve's GDP projection is 0.4 for 2023, which, I watched Larry Williams yesterday's video. He was saying, the economy is good, GDP is up. Yeah. But, their own estimate now shows that it is right now will be for Q1, around 3. So how we gonna, in their own estimations, how we gonna go to 0.4, right? Only we can do it if we had to perform really, really bad on the next quarters. So they expect something big to happen, and they try to politically prepare themselves. That's what I think is happening. And there's a huge risk in terms of portfolio management. And also for this crisis and their drawdowns. Okay, why we focus on 2008 and 20 and 2000 and 2008, right? This is the average percentage drawdown from beginning of recession to bottom of the market. And this is the average percentage drawdown when the curve uninverts. What we mean by the curve uninvert is this yield curve steepening back upwards, which is the moment we are in now. And this is the downside we had. And as you can see, we have big downsides. At 2007, we had like 50%. At 2000, we had like 20. And on the COVID, we had like 13. And we can, of course, there is different numbers. There is also non-existent or very small numbers, but we can use price to earning ratio to decide which one is important for us. And now I think S&P price to earnings ratio is 25%, 25. So we can say these are relevant for us. These numbers are relevant for us. And that kind of gives me this estimation of 50 to 10, so roughly 30% drawdown. And I think that's the risk we see. And also, when I combine it with the technical analysis that can share after this brief, daily brief, after the after party, and also I see another time targets that also corresponds to time window of 60-90 days that we will see something. So I'm trying to position myself in that scenario. And even if that doesn't happen, I think if the market rallies up, and it's not a good place to buy technically, so it's better to wait for a retracement to jump on the wagon. And I think this is as far as my summary for what I see at current state of the market. Yeah, you don't mean me, right? You mean Julian.
Okay, so can I ask a couple of questions, Effie?
Yeah, sure, of course.
Okay, can you zoom in on the left side right there? Can
Yeah.
you zoom back in?
Yeah.
So the up a little bit. Now, okay, so where it says the Fed discount window usage, it seems
Yeah.
like the net percentage banks tightening standards for small business lendings. So that normally spikes up to like this is a percentage. So how do you go above? Is it possible to go? You can't go over, like I see it shows 110, 130. How can you go over 100% of the banks?
Yeah. Yeah. I don't know how they do this numbers, but this is the same chart with the uh, current numbers. It's not the percentages.
Mm-hmm.
For me, it just shows that this is the talk of the tightening that will the
Mm-hmm.
Fed is talking about that's gonna prevent the markets. But that part I don't know. I'm sorry. Yeah, but it's a good question. How they can have more percentage
Yeah,
wise.
I was just curious about that.
Yeah.
Do we have any questions? Any questions on YouTube? Chris, do you see anything over there? I don't have YouTube pulled up on my end, but do we have any macro questions on YouTube that people might want answered from Effie before we switch to TA and the Daily Brief After Party? No questions. Okay, no questions
Okay,
yet.
great.
Effie, maybe you can sufficiently confuse people.
Yeah. In the end, it yeah.
When crash?
Yeah, Ankash, yeah. One like Van Binance makes sense. Yeah, I think we should be careful by summer. That's what I'm trying to position. I'm not saying this is crisis, but it's percentage-wise. I think there are probabilities that shows that direction, and we just need to be prepared for it. Maybe it doesn't.
Can you go to the right back to
Yeah,
your bear versus bull
yeah,
reasons
yeah.
and zoom into that? Credit crunch substitute for rate hikes, more tightening. Okay, but go down. You had those little charts. You had the
Yeah,
April bullishness, and then you had the no scroll, zoom in.
yeah. This is the bullish case. Yeah,
Yeah, this is the bullish case.
like the April is already a good month.
Yeah, it's a
It's
really good month.
really yeah, and also to be honest, it's not like if you are bear, you are more wrong than you are right already statistically. Like even if you coin flip, like 78 months, the April has been 76 up and 45 it's been down. So you are betting on this. And
Yeah. Well, it seems like the market generally always goes up, so of course the
yeah,
months up are going to be more than the months down.
but
If you
just check September is crazy, 50
only
50.
September is equal.
And
But the rest
December
of the
is
time, if you're
yeah,
December is ridiculous. But the rest of the time, if
ridiculous.
you're a bear, you're basically
Yeah.
betting against the odds.
Who said that about that famous short seller? That guy, poor guy, killed himself. However, you are good at this being bear. You are more wrong than right.
Well, I think everyone is a bull. Bears are just people who want a higher discount. Bears, you can tell if someone is a bear or a bull based on their shopping habits.
Yeah.
If they're the type that they won't buy anything unless it's like 80% discount, then that person is in a way a bear.
Yeah.
But if they're okay with like 20% discount, then they're probably just bull all the time.
Yeah, that's how I see myself. I'm just, I'm cheap about this. I like to buy. I like to buy very good price, and I just. It's very good explanation from your side. Yeah. It
Yeah,
will be a
I
good
think it's a good
opportunity if
analogy.
we get a crash. I'm sorry to say, but
Yeah, I agree. I
good.
agree. It's just make sure to buy at the right time.
Yeah.
Can you go down a little bit more?
Yeah.
Okay. Draining reserve liabilities and capital, other factors draining reserve balances. So
Yeah.
this is showing the
This is the
billions of
actually,
dollars.
that famous chart where they show the Federal Reserve balance sheet. That the balance sheet chart. Let me open it. And on that balance sheet chart now, it's up like 300 billion.
Yeah, so you
Listed.
really don't think that affects the market? Because I
Yeah,
remember you said,
I
okay,
listened.
it's not the same as QE.
Yeah, yeah. The idea is that I search for it a little bit, and the thing is that also Paul doesn't say it's not QE, because basically what happens is that, let's say there is a 10 units of money in the market. Okay, I have 5 minutes of money deposited in the bank, and in the COVID, what they did is they just printed money out of thin air and increased the amount of money to 25 from 10. So that was quantitative easing. But now what's happening is that I have 5 units of money and it's deposited in the bank. And when I try to withdraw from the money, that money is locked because they bought long-term treasuries. So then what happens is that technically bank becomes insolvent. Because if they try to sell those treasuries in the market, they will lose money. And if they
But okay, so not I do understand that.
yeah,
But if the Fed is providing this money to the bank, so the bank has liquidity to provide money to the customers, which the customers are
yeah,
withdrawing,
but it's not
that
new
money has
money.
to go somewhere, right?
It's your
It's not
money
new money,
already.
but
Yeah, if you go and buy
that money,
stocks, yeah, it's a liquidity. If you go out and buy Apple, you can say that you had your money in a bank sitting, and you now
yeah.
withdraw this money and you go and buy gold. Actually, it was very interesting. I just put it on my gold chart. Like on the
Uh-huh.
Google searches, how to buy gold is like all-time high now. Uh,
Really?
yeah, so yeah, okay, people maybe if they withdraw it and they go and ahead and buy like physical gold, yeah, and
I mean, that would make sense to me if they were like, okay, well, the banks maybe are fucked, US dollar
yeah,
is maybe in trouble, and they take the money and they're like, okay, let me put it into real estate, stocks, gold, and crypto.
yeah, it could be it, because you kind of like it's not providing new liquidity, but the money was sitting in a bank and you kind of like increase the movement of the money, the momentum of the money, if people are going and buying things with it, which is
Yeah, so
very
that's how I
important.
can,
Is the case for the central bank digital currency, that the money will have a time limit and you cannot just deposit on a bank, you need to go ahead and spend it somewhere. So that's something like that. If it is if that's the case, uh, I have that chart actually on my.
can you just type in Google Trends and then you can type in how to buy
Yeah,
gold
yeah. I'll
trends.
just show it because I have it here actually, and it's crazy. Yeah, it makes sense that people are now buying. No, not this one. Yeah, it was here. Yeah, how to like look at this, right? It's a nice correlation, that the gold spot price and this surge, and now it's very high. So people they want to buy gold now, and they maybe want to buy cryptocurrencies as well. So it kind of makes sense. I can understand it. Maybe that provides a liquidity. Yeah. But the thing I see with the crypto is that, when the Silicon Valley Bank blow up, the Bitcoin didn't start this rally back then, actually. After it was like on, I think, Saturday evening, and USDC lost its peg. And then lots of people, because the USDC lost its peg, they put it on the Bitcoin and Ethereum. And Sunday, when they declared that they are going to save the Silicon Valley Bank, it's become like a narrative. That's how I see it. But you cannot deny the price action. It's very strong. Although, I have a small short position, but it's very strong.
Yeah, I agree. I posted some stuff in our Discord, in my Discord signal room today.
Yeah, I seen it. Yeah.
And yeah, I think
Scares me.
it's very strong. I hate it, but it does seem like the worst case scenario. Okay, so
Yeah.
any closing thoughts on the macro analysis before we
Yeah.
close down the public daily brief and we go to the after party and we jump
Yeah,
into tons of TA?
yeah. Just to summarize, it is I don't. It will just, like you said, give us a good opportunity to buy, and even if doesn't happen by summer, still you are not gonna buy now because everything is like in a very hard place in terms of a long-term investment now. So, and if it's gonna go up from here, you will have plenty of opportunity to buy already. So even if this recession doesn't happen, you will have a better opportunity to buy. And if it happens, you are just prepared to make the most out of it. So I think being on sidelines now makes sense for me. That's what I could recap as final thoughts.
So we've got Effie's final conclusion. We are in no man's land, basically, and don't feel bad if you are sidelined, because maybe that's exactly where you want to be.
Yeah, exactly.
Okay, Chris, do we want to close down this stream and then start up the after party? All right. Final message. Thank you, everybody.
Yep.
Appreciate
Thank
it.
you, everyone.
And we will see you in the after party.
Yep. Bye-bye.
Bye, guys.